Dollar cost averaging is a little bit like playing recreational softball and aiming to hit singles rather than swinging for the fences every time. If you've ever played recreational softball, you've got a variety of different approaches. Some people are going to go out there and they're going to swing for the fences every time, but they'll hit a home run or double from time to time, but they'll also strike out a fair amount. There's other folks that are really difficult to defend who they're going to get back on base almost every time because they're just placing the ball where it needs to be. Dollar cost averaging is a little bit like that. We're never going to have the greatest outcome nor the worst outcome typically as we move through this approach, and that's why it can be very favorable.
So Spencer, today we're going to be talking about dollar cost averaging. And dollar cost averaging is just the idea of placing a set dollar amount into the market at a set interval. So we want to talk about some of the advantages and disadvantages of this, but can you give us another brief overview, maybe unpack it a little bit more for us?
Well, it's the idea that we don't want to load up at any one particular moment and buy everything then, because it might be a great time to buy or it might not be a great time to buy. The market might be expensive or it might be cheap. If we spread out that investment over time, what we know is we're going to have some purchases that are going to be more favorable when things are cheaper, bonds or stocks. We're going to have some purchases where they're going to be a bit more expensive. But over time, that's going to help level things out a bit more. This helps from a psychological standpoint for a lot of people, and it can also help investment returns over time because it builds that discipline in place with a plan. That's the basic sketch. There's a lot of different types of ways that you can implement this over different periods of time, different securities, and we'll walk through a number of different ways that we've seen that to be effective.
And one of the ways that we see dollar cost averaging played out almost every day by investors is when you think about retirement plans. Yeah. And you put in that set amount and your retirement plan invests it for you automatically. Even though most clients don't think of that as a dollar cost averaging plan, that's really what that is because they're thinking about the long term and they're investing a little bit every month over time. So when we think about investment options within a dollar cost averaging plan, are those limited or what can you invest in?
Well, if you set up the plan, you really can invest in anything. Now, the caveat is we have to think about transaction costs, so we do want to be careful with how many different investments we choose, but oftentimes it would be a handful of different investments and you could choose really any period that you want to. So it could be done on a month-to-month or quarter-to-quarter basis. That would be the most typical. There are some folks that would even do it on a week-to-week basis. Other folks could do it every couple of years even. So there's a way that you could spread that out over time. Again, monthly, quarterly, probably the most easy to implement and get most of the value.
So let's think about a couple examples. We got this first one of John, who got spooked by the market and went to cash a few years ago. How could a dollar cost averaging plan help him?
Well, we have a lot of times that we'll sit down with folks and they get spooked by the market. Maybe they're not working with a professional. Maybe they don't have really a plan that's in place that they feel like they can abide by. And we'll walk through a financial plan with them and we'll come up with this balanced portfolio or some kind of portfolio that has some measure of stocks and alternatives and bonds, other kinds of investments. But there is a concern that we move from cash to that portfolio all in one fell swoop. So what we might do is instead move in a very disciplined fashion from cash into that portfolio over a time period, and it may be a year or 2 years or even 3 years. Sometimes it could be a shorter time period, but it's really helping that individual feel like we're setting a plan in place and that we're going to do this instead of based on emotion and maybe what's happening in the financial media or the political realm or whatever it might be. We're setting in place a plan that we can amend, but generally speaking, we're going to abide by because we look at those long-term returns and we know that the thing that impairs those the most is deviating from the plan, selling out at an inopportune time, or getting greedy and buying too much. We can abide by the plan, which dollar cost averaging can help, then that long-term achievement of goals is a lot more possible.
Okay, so let's go to example 2. Emily, she's a risk-averse investor, and she's uncertain about market timing. She's heard some friends have done really well, but some friends have done really poorly. How can dollar cost averaging help Emily?
Well, and let's just say Emily is a business owner. She's just sold her business, and she has this lump sum. It's the same kind of thing. You say, okay, I'm risk-averse. I know that I need to be invested long-term because 20 and 30 and 40 years down the road, potentially, if you're a business owner that's just had a liquidation event, you're going to need some gains oftentimes, or you're going to want to have some gains over a multi-decade period. But you may be concerned about what's happening, right now in the political or economic landscape. Well, this gives you an opportunity to ease those funds into a portfolio that's very well diversified over time, and so have a better opportunity to achieve the goals without taking on a tremendous amount of risk at any one point.
Okay, so the final example, we've got a young professional, long-term investor. We kind of already touched on this in investing in the 401k, but why is this so beneficial, dollar cost averaging, for a young investor?
Well, it gets in place good rhythms. It gets in place a good cadence to just expect, okay, it doesn't matter if the market is up or the market is down, I'm investing some here. So let's just say it's $1,000 a month that's going from the paycheck over to the 401k. It's actually in that individual's best interest if the stock market is down, believe it or not, because they're buying cheaper shares. The stock market, we joke, is the only market in the world that's been known when things go on sale, people run for the exits rather than trying to buy more. So dollar cost averaging, if you think about it, and you're buying a security that goes from $100 down to $50, and you have $1,000 to put in, why, you get twice the amount of shares. And if you believe that those companies, this is where we need to come back to, we're buying companies. We're not buying into the stock market in a sense of it's this ethereal thing. We're buying actual companies that produce goods and services that go up and down over time, but we're buying managed companies there. So as we do that, if we can get them for cheaper, if you could say, okay, well, I can buy one share of Apple stock, and one day it might be selling for $180, and if things go really poorly in the economy or there's bearishness, and 2 months later I could buy it for $140, that's a value right there. And dollar cost averaging just puts in place an operational way that is within our plan. And so that younger professional, it could help her be able to sequence things and stay in line with the plan.
So we've talked about a few of these kind of roundabout ways, but some advantages of dollar cost averaging. Risk mitigation. You think about when the stock market is up, you're still investing. When the stock market is down, you're still investing. Can you unpack risk mitigation a little bit more for us?
Well, risk mitigation is a really nice feature because it smooths out the ride, as we've talked about. There have been studies even here of late that have shown that if the stock market is a bit expensive relative to its history, the price of stocks relative to earnings, that the risk-adjusted rate of return, how much return we get for the amount of volatility on that ride, can be enhanced by a dollar cost averaging approach. So that can be a really nice thing. The other thing with risk mitigation is it can help mitigate our own emotions. Because if we are abiding by this plan and we get in and we have just a cadence that this is what we do, then that can help us overcome some of those emotions in the midst of the ride that can be what really drives our performance down.
Which in that kind of plays into that second advantage of being a disciplined investor, of continuing to choose over time, even when you see markets up or markets down, that you continue to investing and building those habits and saying, I'm going to keep doing this, even if I feel scared or if I feel elated, I'm not going to add more or take away less, because it is creating those habits of long-term financial outlook. One of our next advantages is potential lower average cost. We kind of talked about that a little bit, where you could buy Apple at 180 or 140, but the average cost goes down if you're continuing through those bear cycles. Is there anything else on that you want to touch on?
Well, the nice thing about here is we can set a plan in place, but if we find that there's a more opportune time to buy, let's say we see a stock market drop of 20 or 30%, there's nothing to say that we can't accelerate that dollar cost averaging plan. So we want to be selective here. We don't want to get out over our skis, but we have had many times, including when the COVID lockdown happened, where we reached back out to clients and said, do you want to accelerate this dollar cost averaging plan, because stocks are rather cheap right now relative to where they were a month or 3 months ago. So it does give us that opportunity to potentially buy more at an average lower cost.
So the last advantage we want to touch on is just long-term wealth accumulation. And again, we've talked about this a couple of ways, but what do we really want to focus on here?
Well, the consistency just builds those muscles of endurance over time. So we accumulate over time. We just have that cadence, that rhythm where it's part of our psyche. This is what we do as an investor. So that buy-in can help create that long-term wealth accumulation.
Okay, so we've talked about some advantages. Let's go to disadvantages. And we as long-term investors don't believe that you can regularly outtime the market or correctly guess or project when the market's going to go up or go down. But there is a possibility that you can miss some opportunities. Talk about that a little bit for us.
Well, at really any moment in time, there's a good line of thought that would say, we don't know what's going to happen, but stocks, generally speaking, have outperformed bonds. Bonds, generally speaking, have outperformed cash. In these events where we have a lot of resources in cash and we got a lump sum maybe, or maybe we got spooked and we've just been in cash for a period of time, there's a potential that if we don't deploy those resources into the portfolio that's going to be best for us long term, that we're going to miss some of that initial early gain. So we have to grapple with that. You could certainly say if you receive the resources, the best time is to go ahead and just invest immediately, get everything moving in that direction. And statistically speaking, the rates of return, if we look back over history, they have actually been best if we go ahead and deploy all of those resources immediately. But that's not in every circumstance, and sometimes that leads to the investor behavior that actually is not good on the other side. So it's the consistency there, but you can miss out on some opportunities if you don't get every dime invested as aggressively as possible, at the very outset.
Okay, so let's talk about another disadvantage, the potential for transaction cost. So some brokerages charge transaction costs based on the types of investments that you are entering. So if you have a dollar cost averaging plan where you're buying into a mutual fund, let's say, that has a $5 or even maybe a $20, $25 trade charge, some of those transaction fees can really build up. So maybe how can we offset those transaction costs?
Well, it really comes back to selecting the options that are not going to incur those at a level that's going to be onerous. So we think about the amount that's going to be invested on a dollar cost averaging basis. And if we're trading an ETF, usually there's not an expense to that for most custodians. A lot of mutual funds, there's not as well. But sometimes those mutual funds or even those situations, there will be a higher ongoing expense. If we could get into institutional share classes, maybe that expense is lower, but there might be a transaction charge. So there's some things that we've got to grapple with as we put in place a system. Some of that comes back to how often are we buying? Could be monthly, could be quarterly. If we have some transaction charges, maybe we just push the buys to a quarterly basis. So lots of different things that we've got to grapple there, but we don't want to have a dollar cost averaging plan, say going into a Roth IRA for an early career professional that might be $100 on a month-to-month basis, but get eaten up by transaction charges, even that might be $5 just for that purchase. That's 5% of the amount that would go in. That's not a good deal. So we've got to be careful as we think through the funds to use for dollar cost averaging.
So this third disadvantage, possible lower returns during bull markets. So speak into that one a little bit for us.
Well, it's similar to the first part. We think about a diversified portfolio and getting everything invested early. We don't know when a bull market is going to show up. But if we don't get resources really over there quickly enough, then we're going to miss in some of our resources the upside that happens there. Now, again, what we have observed with clients over time is if we set up the plan, then one of two things is going to happen. If the stock market goes up, wonderful, we already got some resources invested. That's better than just keeping it in cash. So that can be a win. The other thing is the stock market goes down. Okay, well now we get to buy shares at a cheaper level. So that can also be a win. So if we set up our conditions within the plan where our perspective is in line with the plan, we're in good shape. But if we said, I missed out on some of these assets that weren't involved in that bull market, again, we just have to make sure that we're comfortable with the trade-offs there.
So Spencer, we've talked a lot about the long-term investor. Is dollar cost averaging, is it worthwhile for a short-term investor?
We have to define short-term investor. is this someone that thinks that he or she can time the market, get in and out? And certainly it's not a good fit for that person. Our opinion is that, and our belief in the way that we build plans is that we're not going to effectively time the market, that's not something that is worthwhile in pursuing. We do have people who have investments that are a shorter term horizon in terms of when they'll use those investments. So think about someone who maybe they're saving for the purchase of a second home, and they have $50,000 now. They want to be saving $50,000 every year towards that purchase over the next 5 years. If we're thinking about that and we're saying, okay, we want to dollar cost average in a very, very conservative way and continue to accumulate those funds such that we know that we're going to purchase something probably in the next 4 or 5 years, then it can be appropriate. If we have an approach, though, that we're going to be buying into, say, stocks or something, we think that we're going to be investing aggressively, that's a mismatch in terms of when we're going to use those resources. So we have to be very careful about that. We want to make sure that we always have that portfolio and the ups and downs of the potential portfolio aligned with when we might use those resources. So for a short-term investor that says, well, I'm going to need these funds in the next year, then we're going to almost always say, well, let's just make sure that you invest that in some kind of a high yield money market investment or something that has, some FDIC insurance, something that's not really going to go up and down in the same way that a stock and bond portfolio will.
Spencer, we've kind of focused dollar cost averaging here when we've thought about the Roth IRA, the 401k, some of those normal retirement type savings accounts. When you talk about the business owner that may have received a lump sum, that's going to be put into a taxable account, a non-qualified account, if you will. How does a dollar cost averaging plan, how does it change based on those tax implications of a non-qualified account?
Well, it doesn't really change too much from a psychological standpoint. There's value there, but it can add a little bit of extra help when we think about a non-qualified account because you're buying shares at various levels. So if you want to get into really the nitty-gritty on how you can use those resources, if you buy shares of stock or bonds at different levels, it gives you different cost basis points that sometimes you can use to leverage when you sell those pieces later on or when you gift those pieces later on. So in the most simple example, let's just say that we had $100,000 that we were going to dollar cost average into Apple stock. This is certainly not a recommendation to do that, but let's say you did it in 2 tranches, 1 year apart, and so you put $50,000 in one day, and let's say $50,000 in 365 days later. Let's just say Apple stock was at one point, and then it dropped, 50% in terms of its value. Well, the shares that you purchased in that second tranche are going to be, as we've mentioned, a lot cheaper. They're also, if we look at the long-term perspective, though, if you have that same value, overall in both sides of things, it's going to be very interesting because you may be able to gift the lower cost basis shares to a donor advised fund and never have the gain applied to you, whereas the higher cost basis shares, maybe you sell those or maybe you pass those on to a loved one via a gift, but that higher cost basis doesn't hurt you potentially as much from that tax planning standpoint. So it gives us a little bit more of an opportunity to do some tax planning there if we're in a non-qualified account with some dollar cost averaging. But the key value I think that we come back to is keeping it as a part of the plan and keeping the psychology of long-term investment front and center.
Yeah, so as we close out today, really we come back again. We have to know our goals and we have to know the plan, and then we use dollar cost averaging as a strategy to help attain those goals and maintain fidelity to the plan, because we want to be long-term investors with goals in mind, with a desire of where we are headed in the future. If we don't have those goals, if we don't know what the resources are going to be used for, the strategy really at that point doesn't matter as much. It still is important, but really you need to know, what are my goals, what am I saving for, and why am I saving towards these goals? So if you want to build a collaborative financial plan, we would love to have a conversation with you. You can look in the description of this video and reach out to our firm and set up a time for a quick 20-minute insight call to see if we would be a good fit to work with and set up a plan for you.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SeriousRetirement.com.
This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.